Hello everyone, and thank you for joining us for another episode of AM Trading. Today's video is an advanced tutorial focusing on the principles of market structure in smart money trading. In this session, we delve deeper into identifying trends, breaks, and reversals, which will revolutionize your approach to chart analysis. We will teach you a systematic process to mark and map the market structure and integrate multiple timeframes, mimicking the techniques of a seasoned professional smart money trader. If this topic interests you, please hit the like button to show your support, and don't forget to subscribe to our channel if you're new. The initial stage in examining the market structure involves pinpointing reliable pullbacks. These pullbacks represent brief pauses before the price resumes its typical trajectory, helping to establish the primary price movements, trends, valid breaks, and reversals. The process of identifying a valid pullback is rooted in candlestick-based concepts. In an uptrend, defined by a series of bullish candlesticks that surpass the peak achieved by the prior one, the market exhibits ongoing upward momentum. The low point of each candlestick remains above or equal to the low of the previous candlestick, suggesting that the market's downward force is restrained, and the overall trend remains predominantly bullish. Conversely, in a downtrend, characterized by a sequence of bearish candlesticks that exceed the minimum reached by the previous one, the market shows consistent downward momentum. Similarly, the high point of each candlestick stays above or equal to the high of the previous candlestick, implying that the market's upward force is limited and the overall trend remains bearish. In addition to evaluating market trends, it's equally crucial to pay attention to candlestick-based trends. Now, let's discuss how to identify a valid pullback in a bullish scenario. A valid pullback is determined when a candle breaks below the lowest point of the previous one and sweeps liquidity. For instance, in the fourth candle of this example, you can observe that it has broken below the lowest point of the third candle, thereby forming a valid pullback. If the price couldn't break downwards, then the pullback would not be valid. Remember, the color of the candle doesn't matter when identifying pullbacks. Similarly, in a bearish scenario, a valid pullback is identified when a candle breaks above the highest point of the previous one and sweeps liquidity. Let's examine some additional examples for a clearer understanding. In this instance, we're observing a sequence of bullish candlesticks followed by several bearish ones. The latest high forms the subsequent low, but this isn't a valid pullback since none of the candles broke below the low. This is essentially a move within the previous candle, and we have no liquidity sweep. Therefore, we'll classify this as a single bullish movement. This scenario mirrors the one depicted in the second diagram. Here, the market sentiment is bullish, but it hasn't breached any previous candle's low, which means there's no valid pullback. However, let's shift our focus to the third diagram. In this scenario, the bearish and bullish candles have identical highs, making the low of the bearish candle a valid pullback. This principle applies to bearish markets as well. You can apply this methodology to any chart and time frame. Once we've discussed pullbacks in terms of candlestick formation, let's talk about impulsive and corrective moves in terms of market structure. In an uptrend, an impulsive move refers to a strong bullish movement indicating heavy bullish momentum. On the other hand, a correction refers to a temporary market retracement or reversal that takes out a pullback. A break of structure occurs when the price breaks above a market structure level after a corrective move. Forming our recent higher low, it shows that the market intends to continue in the same bullish direction. A change of character occurs when the price breaks below the lowest point of a corrective move, indicating a loss in momentum and possibly a reversal in trend. Starting from the bottom, this is our single impulsive move that contains multiple pullbacks in terms of candlestick formation. The following move is corrective since it has taken out the liquidity under the most recent pullback. After the market forms a corrective move, we define this level as a new higher high or a market structure level. If the price breaks this structure to the upside, we will have a new higher low formation. The end of corrections or the start of the impulses are critical levels in terms of market structure. As long as we stay above these levels, we identify this market as bullish. If the price manages to break and close below these levels, we're no longer in an uptrend and it signals a possible reversal. That's why we call it a change of character. The same concept is applied to the bearish scenario. Here, we have impulsive and corrective moves in terms of candlestick. These moves are corrections in terms of market structure. reading since they have taken out the liquidity above the minor structures defining the lower highs. The change of character occurs if we get a break and close above this level. Before we proceed to the next topic, which is analyzing market structure in multiple time frames, let's consider this. If you'd like us to produce more videos more frequently, please support us with your likes and comments. If you're keen on learning more and view our trades transparently, do join our Telegram group, which has one of the best trading communities. We provide only high-probability trade signals. Join our Telegram group to secure your spot before we close up soon. Link in channel description. See you there. By analyzing structure and structure, we gain a comprehensive view of market conditions, allowing us to spot key levels, trends, and patterns that may not be apparent in a single time frame alone. Multi-timeframe analysis allows us to make better trading decisions, minimize risks, and increase our profit potential. So, how exactly do we analyze structure in multiple time frames? Well, we have two types of time frames in our trading plan. A higher time frame for analyzing the overall direction, higher time frame key levels, and generally, the bigger picture. And a lower time frame where we perform most of our analysis, including analyzing market direction, supply and demand areas, liquidity zones, chart patterns, potential trading opportunities, and more. After applying the concepts of market structure, pay close attention to the alignment of structures across multiple time frames. Look for confluence and agreement between the two charts. When structures align, it strengthens the validity of your analysis and enhances the probability of a successful trade. Let's see an example on a real chart. Here, we have the GBP/USD chart in a 4-hour time frame. This is our higher time frame chart, and we will later zoom into the 1-hour time frame to observe more details and combine our factors. We have an obvious downtrend. Let's identify the most recent impulse, correction, and pullback. This is our latest pullback because it has taken out the liquidity above the previous candle that created the recent high. This move is our latest correction since it has taken out the liquidity above this pullback. As long as we stay below this level, we will identify this as a bearish market. Let's see what the market does now. After a break and close above the latest lower high, the market sentiment changes to bullish. Our higher time frame shows that, after a long period, the downtrend is over and a possible reversal is coming. Now, let's zoom into the 1-hour chart to observe more details. In the 1-hour chart, we can see that the market has signaled a change of character much earlier. This is our latest correction, which created a break of structure and defined our latest lower high. Then, we can see that the market failed to create a lower low, and finally, the price led to a change of character. Right now, both 1- and 4-hour charts signal a possible reversal. We can look for buying opportunities by combining multiple time frames. Combining multiple time frames offers many benefits, including gaining a broader perspective, confirming trends, identifying entry and exit points, and enhancing risk management by considering different time intervals. You can make more informed and strategic trading decisions. That is all for today. Thank you for taking your time to watch this video. I hope you found it informative and valuable. If you did, remember to click the subscribe button and enable notifications to stay informed about our latest content. Your feedback is important to us, so feel free to share your comments below, suggesting topics you'd like us to explore in future videos. Thank you for your support, and I look forward to having you with us in the next episode.